The Fed chose to hold rates steady at the end of the recent policy meeting, but issued some warnings on the path forward. In today's video, we're going to look at what happened in the Fed's latest meeting, what they are concerned about in the economy, and what it all means for mortgage rates. Let's get into it. At the end of their policy meeting on March 7th, the Federal Reserve chose to leave their Fed funds rate unchanged. This was not much of a surprise, but what was more informative was the warnings about the path forward and what it could mean for interest rates in the months to come. The uncertainty around President Trump's tariff policies were front and center, and the risks of stagflation were highlighted as a potential outcome for the U.S. economy because of those tariff policies. Stagflation is a period where economic growth is low or negative, while at the same time you have high inflation and rising unemployment. I did a video on the topic recently. If you want a deeper dive on the subject, I'll leave a link to it in the description down below. Basically, stagflation is not a good economic environment to be in, and it's keeping the Fed up at night. Rising risks to the economy from tariffs have the Fed in a tight spot. Do they raise rates to fight off higher prices, or do they lower rates to keep the labor market from weakening? In the end, they opted for a wait-and-see approach before reacting to any potential tariff impact on the economy. The Fed has a dual mandate: stable prices and full employment. But here's the problem. If the economy enters into a period of stagflation, you could have a weakening labor market in addition to rising inflation. So, which side of the mandate would the Fed work towards if it became a reality? No one knows, not even the Fed. Jerome Powell is a man who likes economic data. He's a man after my own heart. I love data, and that's why I like to bring hard data into my analysis each video rather than give you a bunch of speculation that's not backed up by anything. And the data is what the Fed is going to be looking at to determine their path forward. Right now, the economic data isn't that bad. In my last video, I presented the latest data on the U.S. economy. Yes, GDP growth was negative in the first quarter, but that was mostly due to a surge in imports ahead of tariffs being implemented. The April jobs report showed hiring maintaining a steady pace. Any damage the current tariffs might do hasn't shown up in the data yet. It's just too early to tell. One thing I'll be doing on this channel is releasing several update videos a month, keeping you on top of what the latest data is showing. It's the same data the Fed is going to be looking at to make their decisions. So make sure you're subscribed if you don't want to miss those videos when they come out. Now for the next question, what does this all mean for mortgage rates? As of May 8th, the average 30-year fixed-rate mortgage was at 6.76% according to Freddie Mac, which is high enough to keep activity in the housing market at historically low levels, especially given how high home prices are as well. There are a few paths forward for interest rates and ultimately mortgage rates in the months ahead. The first scenario is that President Trump essentially backs off his trade war with the world and tariffs come back down. That's the dream scenario, but I'm not sure how likely that would be. If it did happen, then the economy is likely to continue growing, companies will continue hiring, and we will keep coasting along. The Fed would likely return to lowering their Fed funds rate as they became more confident inflation won't pick up again. The second scenario is that President Trump doesn't back off on tariffs, prices rise, economic growth slows, and the labor market weakens. That's the stagflationary environment I mentioned earlier. Now, I am going to do a little bit of speculation, and this is just my own opinion. I think in that scenario, the Fed would actually choose to lower their Fed funds rate to support the labor market. Remember, they have a dual mandate: stable prices and full employment. I think they would choose to support employment, thinking that price increases are going to be temporary because the tariffs are a one-time increase in prices and not an ongoing increase over time. This would likely lead to lower mortgage rates if the Fed lowered their Fed funds rate close to zero, which is what they have done in past economic crises. While that may be good for some prospective homebuyers, we have to remember that we would also be in a weak economic situation in that scenario, which can put downward pressure on housing demand. The third scenario would be that Trump continues tweaking his tariff policies enough so that we don't see the worst price increases and perhaps the economy could continue growing without too much disturbance. It's a bit of a Goldilocks scenario, and I'm not sure how likely that would be either. In that scenario, the Fed would likely keep their Fed funds rate steady, given that prices wouldn't be rising too much and the labor market would weaken not too much either. The sad reality in that scenario is that we wouldn't see much movement in mortgage rates either. What do you think? Will Trump back off, double down, or masterfully manage his tariff policies? Let me know in the comments section down below. And if you like this video, don't forget to leave a thumbs up to support the channel and help it grow. I'll keep releasing updates along the way, so make sure you're subscribed, and I'll see you in the next video.